This is episode 12. I'm doing it solo today. Reason being is I want to be a little bit more data driven. And we do that about every third or fourth podcast. All right, so yesterday, so that would be August 10th, because this will probably come out in about a week, the markets are reacting incredibly good to the news that the Federal Reserve said in terms of inflation numbers and what they see for the horizon. And let's talk about that. First off, we really want to keep an eye on what's happening in the marketplace, because that really governs the economy, that governs what's going to happen in housing. It's very important. And I had somebody message me last week and said, Jason, have you ever, because I have a ton of clients who follow me on social and we do snippets of this stuff, and I talk about the market 24/7. And they said, have you ever told people what you did for a living before you sold houses? And I said, well, I really haven't gone into that. So before we get into this one, I'm definitely going to jump into that for a little bit. So before I sold houses, I actually worked on the trading floor. And not only did I work on the trading floor, but I actually traded euro dollars. Now, euro dollars you would think is European euro. No. Euro dollars on the CME, the Chicago Mercantile Exchange, is actually trading the interest rate. So when I speak to people about the marketplace and interest rates, which really govern housing, I have a really good grasp of it because I sat and traded interest rate products for years. Not only did I trade the interest rate and where it is now, but we actually, and the Merc, traded where interest rates would be from years from now. So that's called the yield curve. And we're not going to get crazy into it because people say I lose people when I talk to financial. All I'm saying is that I have a very good grasp of where interest rates are now and what affects interest rates. So let's just say 2 months ago, when I got on social media platforms and the interest rate was right around 6.5, and I announced on all of my platforms that this would be the dead high and that we would see 4 before the end of the year, I had hundreds of comments. I trended pretty hard on a couple platforms, people just basically making fun of me. And what I said is that, hey, listen, I'm not just saying this for a hot take. I was taking a look at the charts of lumber, oil, corn, meal, all that stuff. And the reason why I looked at that stuff, and the reason why you should look at that stuff if you're into housing or just into the economy at all, is that everything's built with lumber. Corn is crazy. Corn literally governs everything because corn makes meal, right? So corn, the price of corn not only affects the food that corn is, but the big thing is it makes meal. So the price that people have to pay for corn to feed their meat and their cattle affects the price of meat, which then affects the price of the grocery store. So like when you look at, for me, what I'm looking, and I made that statement 2 months ago, I looked at lumber, oil, and corn. If you keep an eye on those 3 things, those 3 products, you can really tell where inflation's coming, going, and what's happening with prices. Lumber, oil, and corn all started to turn a couple months ago. And what I was saying a couple months ago is you can't look at the inflationary number that comes out, right? So the number that came out was 8.5% inflation. Now, if you look at that number, you're like, holy shit, that's a lot of inflation. And the market took good because it was like 9.5 the month before. But what we talk about all the time, that inflationary number is year over year. That data is such a lag. It's such a rear looking data point because you have to look at last year. Obviously, anything you look at from last year, 2021, to today, inflation is going to be crazy high because the overnight lending rate, which we've talked about, what banks lend for, was 0. So obviously the inflation numbers are going to be, the rate of inflation last year is going to be so low compared to this year because we had to raise rates. So year over year, it looks terrible. But what did we talk about? If you look over day, month over month, the numbers were all coming in, right? I was talking about lumber. At that time, 2 months ago, The high in lumber was $1,400. At that time, lumber was right around $900. So that downward trend was happening. The downward trend in corn was happening. Oil was at its peak $122 a barrel. When I made that statement, oil was at 105. Oil right now is at 88. These are huge moves. The problem is the data that the government and the Fed spit out to you on CNBC or Fox or any program, CNN, whatever, all these numbers, they don't give you the month to month. They're giving you to the year to year. So the statements I were making were educated statements that if I was on the trading floor, I'm betting you interest rates are going to fall. I would bet on that and I would have won big money. Damn it, I'm not on the floor anymore. It would have been nice. So that trend is what traders look at. And then the traders turn around and they trade the 10-year. We talked about this. The 10-year bond is what basically governs the interest rates, okay? The 10-year. All of these inflationary numbers, lumber, oil, corn, they go straight into what traders feel inflation is going to be in the future. What they feel the inflation is going to be in the future is what governs that 10-year. As the traders think that inflation's not going to be bad, the 10-year drops. As the 10-year drops, rates drop. So let's think about this. This is what's crazy. 3 months ago, the Fed raised rates by 3/4 of a point. Couple weeks ago, they raised rates by 3/4 of a point. During that time, the 30-year mortgage rate has dropped a full point. So the Fed has raised rates by 1.5%, yet traders pushed it down a full point. That's why I said you always can't just look at what you hear. You've got to look at the data, especially. What does that data mean? So let's go through a couple of stuff that we talked about. The Dow, when the Fed raised rates by 3/4 of a point, whatever that was, 2 months ago, the Dow now is the highest it's been since May. January, February, March, April, May, right? So we are the highest point we've been in May. The Dow today is looking to jump another 200 points. So that's a jump of 500 points since they came out and said that the inflation is up 8.5% year over year, which should seem like a bad number. But they're finally letting you know, hey, we see inflation starting to go down, because they're finally letting you know the day-to-day number on the raw materials. Let's do this. The 10-year, since they raised rates 1.5 basis points, the 10-year has gone from 3.5 to 2.7, like we talked about, a full point down. Oil, 122 to 88 a barrel. That's a massive drop in energy. Corn, 784 to 624. This is the big one, lumber, right? Because this sets the prices for homes, and also builders have to make up that price. So, and a house is made with lumber. Lumber's gone from 1,400, that was the high, to 601. I mean, we're talking about an over 50% drop in the price of lumber that they're paying for to build a home. I mean, it's crazy. And a lot of people 2 months ago were saying, this is going to be like when Carter took over the 70s. Okay, in 1975, we got to 12% inflation. In 1980, when Carter lost and went over to Reagan, it was 14%. The high that we hit was 9.2 year over year. So that's not even actual, right? That's year over year. It was already trending down at that point. Nowhere near where we were in that time. And that time was more of an oil shortage. It was more of an energy push, which is much different than what we had now. That's why I'm telling people it's not the same thing. So these are really important things to know. If you're a real estate investor or you're looking to get into the market as a first-time home buyer, or you want to up buy, what does this mean to you? Okay, this is what people that are coming to me now and buying now, this is what they're saying to me. And man, I'm so proud when I hear this. They say, we know rates are around 4.5%. They are. They've gone from 6.5. I just got quoted a 30-year jumbo at 4.5. So we're close to my prediction of 4 by the end of the year. We'll get there. So they're saying, we know that rates are low again, inventories are low, but the sentiment is bad, right? So if the sentiment out there is bad, And for the first time, they said good news yesterday, which is crazy. That so the media, man, they got to sell papers, they got to sell clicks, right? So they were selling bad for so long to get this attention. I think they're kind of wearing off on the bad. Yesterday was the first time they said a couple good things. What buyers are doing right now, and why I think it's a great time to buy, is you're still buying at a time right now where the rates are good, inventory's picked up a little bit. We'll talk about that. Not a lot, by a little bit. But you're going to have an opportunity to catch sellers that are caught up in this media. Everything's going to fall apart when it's not. So you can actually be a contrarian right now, which is how you make money. But you're a contrarian in a good economic situation, which hardly ever happens. This is why I bought something about a month ago, and I'm actually closing on another piece of property at the end of this month, a little small single family to rent. So it's a really good time to buy because you're catching this thing. Now, I also think rates are going to drop further. So if rates keep dropping, what happens? You're going to get all these buyers that we had last year and the first time of this year. They're all going to come back into the market. We still have these low inventories. The buyers are going to flood back into the market. And what's that going to cause? It's going to cause another price hike. We're going to still get, believe me, 4 to 8% of appreciation next year because you're going to see rates dip below 4% and bring people back in. What causes those price hikes? A lack of inventory. And we still have that. So are we in an inventory market that we were last year? No. Even an inventory market that we were in at the beginning of this year? No, we're not into that. In Chicago, we actually dipped below 1 month supply. I think we bottomed out at like a 0.8. That's insane. So when people talk about month supply and housing supply, let me explain that. That means if no one buys a house in 0.8 of a month, so in 3 weeks, you literally have no homes. We're out. You want to move to Chicago? I'm sorry. There's no homes here. We were under a month. We are now at 2.8 months, which is still incredibly low. A balanced market is 6 months and about 90 to 120 days to sell. So all those people that are just getting involved in real estate, agents, whatever it is, and you saw stuff close in 5 days and now it's closing in 30 or 45. 45 days is still extremely fast for a piece of real estate to go under contract. The norm was between a 90 and 120 in 6 months. So you still have this incredibly low inventory. Now everyone is saying, they're saying inventory rose higher than it's ever rose since 2000 and God knows what. Well, yeah. If you only have 5 homes on the market and 3 more come on the market, that's an over 50% increase in homes. However, you still only have 8 homes on the market. The inventory still sucks. So let's go over that. I'm going to get into that. We're going to be a little data driven today, which is crazy. All right. First and foremost, for the first time in the United States of America, the median sale price is over $400,000. That's the first time that's ever happened. That's crazy. So this is real data, right? So if you're telling me the market's falling apart, why is this occurring? If prices are going up and inventories are lower, that means the demand is still there and there is no supply. It's straight economics. Without supply, you don't need that much demand to keep something going because there's no supply. All right. Let's just talk about the city of Chicago for a little bit. I know people listen to this that aren't in Chicago, but we're going to talk about Chicago. I live in Westtown. That's Bucktown area, Wicker Park. Let's talk about that. All right. So this is year over year. Last month, year over year, prices are up 14% and inventory is down 20%. The average time a house is on the market is 30 days. And the percent of original list price, so the reduction, is 99.3%. So only 0.7% off asking. And the average house sale is 1.12. Last year, it was 981,000. Amount of new listings. So all this influx of inventory that's coming, I mean, I'm waiting for it. I have buyers that we're all waiting for it, is down 6%. So you've got a market where the amount of new listings is down 6%. And they'll be like, closed sales are down. Of course they're down. There's less listings. So closed sales would be down. That's just how it goes. So if you want to paint a bad picture, you would be like, oh man, closed sales down 22%. And they just leave it at that. What they don't tell you is all the data. And that's what I want to tell you. Median sales price up 14%, inventory down 20%. That is a tight market. That is a seller's market. However, you're starting to see some discounts coming on. This is the time to take advantage of it, because as soon as rates drop where they're going and the news turns good, because that good news sells papers, we're going to have the same thing. Let's talk about Lincoln Park. It's a very affluent area. A lot of my clients live in Lincoln Park. New listings down 10%. Sales price up 33% year over year. So from the greatest year in real estate to what everyone is saying is a terrible time right now, pricing is up 33%. And this is not a small amount. This is on 60 sales. 60 sales in 1 month on single family homes, up 33%. Inventory down 32%. So skyrocketing prices, lower inventories, and lower new listings. And rates are dropping. So you tell me what's going to happen. Okay. Lakeview, Roscoe Village, East Lakeview, Southport Corridor, which I love. Wrigley Field, I love. I was there yesterday. All right. New listings. Okay. Down 39%. In June of 21, which was considered the worst inventory last year, we had 43 new listings. This June, 26. Median sales price, 1.3 to 1.7, up 29%. So new listings down 39, median sale prices up 29%, inventory of homes down 49%. You tell me what that's setting up for. Let's just go over those numbers one last time. They're nuts. Detached single families, new listings down 39, so people can't find homes. Median sale price up 29%, and inventory of homes sold 50%. There is just no inventory. No one was building houses for years because everyone was so shell-shocked, and no one has places to buy. And you're going into an environment where prices are dropping, the rates are dropping, excuse me. So as a seller, if you're looking at selling in September, October, November, it's going to be great because I think you're going to be competing with less places, and on top of it, rates are going to drop. As a buyer, man, you wait till January, February, and March, which is Chicago's like crazy time. It's going to be nuts. You're going to have an incredible amount of people bidding against this stuff, and you're going to lose out, multiple offers. Take advantage of the fact that people that are not listening to this, take advantage of people who are listening to the media. This is the time to try and get a discount. If you don't like 4.5 on the rates, don't worry. Remember this, you marry the house and you date the rate, right? Marry that house. As rates drop, if you want to, you can always refinance. What you can't do is get the house for that price before they go back up. I truly believe that. I have been right all year. I've had a couple naysayers throw me props, and I appreciate that, but I'm telling you, that is what's going to happen. Let's talk about, let's see how we are in time here. All right. I want to also talk about this. So another thing, if we do, let's just say this thing turns and we do go into a little bit, now people say that's a recession, but it's, and by textbook terms, we are two quarters of declining. So it is a recession, but it's a little bit odd since we came from such an amazing space. And I think that dip has kind of stopped it. We kind of pulled up, but history proves recessions do not equal housing crisis. In the last 6 recessions, 1980, 81, 91, 01, 2008 credit crisis, and 20, real estate's gone up an average of 6%. The only time it went down was 2008. And in 2008, that had nothing to do with the recession. That literally, the banking system almost failed. So everything was, I mean, you just could not get a loan. Now, I will tell you, my friends who had cash in 2008 made $1 gazillion because they were buying everything for pennies on the dollar. They were contrarians. They waited 5 or 6 years and sold everything for double. So that was actually pretty nice. I also want to talk about the fact that 20% of the economy is real estate. So when we talk about real estate and we talk about the trends that are happening here, these trends, like when we talk about housing is starting to hold, prices are going back up, the rates are dropping, that's also going to pull the real estate market up, right? So if you're having rates come down, and all of a sudden you feel like I feel that the economy is holding and is going to be better next year, as that economy starts to go up again, the Federal Reserve at some point, the rates will come up. Getting into real estate at this point in a low rate environment as it goes up is a hedge against that inflation. So that's kind of why you want to get into real estate too. Investors see this. This year, 18% of all the inventory that has been bought. Now, do they know these numbers are 100% correct? No, but there's probably a plus or minus of 2 or 3% on this. But they're saying, Goldman Sachs is saying 18% of all the homes in the nation are being bought by investors. And that's going to be big money people, BlackRock, all this. So they are buying up all of this stuff and turning it and renting it. So, and that's the single family home market that they're dominating. So that is another reason why you're seeing this short supply, is that they're buying all these homes and turning it into rentals. Let's just say we do have pricing. This is going to lead into my last point. Let's say we do have pricing that goes up. This is a great situation. This is why I'm a buyer right now. I feel that pricing is going up. I feel affordability is still going to be an issue. I don't think affordability is going to change soon, especially in major metropolitan cities. So what do you want to do? Well, if you've got some extra capital hanging out, what you want to do is buy investment properties. If you can get your hand on some investment properties right now at these rates, as the economy turns and gets better, you're going to see rents continue to soar. And this $400,000 for the first time, this median income price is going to keep rising. As all this rises, affordability to buy becomes harder. As affordability to buy becomes harder, rents increase. How do we know this? Well, over the last year, every month to month in the city of Chicago, rents go up like 7%. It is nuts. Chicago is versus buying, Chicago is the most expensive city to rent. So it's more expensive to rent in Chicago than to buy than any other place. Obviously, rents are higher in New York, higher in LA, Seattle, other places, but the prices are higher. In Chicago, the spread between owning a place and renting is massive, which gives you great returns. The average returns that I'm seeing are between 6 and 10% in the city of Chicago in nice areas. You're just not going to get those returns. In California, it's like 2%. New York, it's 2 or 3%. That's why it's an amazing place to buy investment properties in the city of Chicago, because the amount of returns you get. Now, some of the tenant laws are a little crazy, but in any major city, they are. California and New York are kind of the same. You kind of got to get really to the south or rural to kind of get better tenant laws, be more towards the owners. But that is what it is. That's how you're playing. That's what you play with, those rules. But that's where you want to be playing. As you buy investment properties and the rents continue to increase, I don't want you to forget this one thing. When the bank evaluates that rental property, they're evaluating on the rents that you receive. As they evaluate on the rents you receive, the equity that rental property goes up. So I'll leave you this one interesting quick tidbit. If you want to know how much it affects your price, think of this. You take the rents that you get minus your expenses, and that's your net operating income. I'll make this super easy for you. You take the net operating income and you divide it by the amount of money that you make in that area. So 6%, 7%, that gives you a dollar amount. Every time that your rent goes up, the value of that property goes up. So if you buy something for 50 grand and the value of that property is, let's say, $500,000. In this market where interest rates are, if you can just increase the rents by $500, that bank values that property at $600,000. You can borrow usually about 75% of the equity that you have in that house. So if you buy something today at 4.5, 5%, whatever the rate is, and in the next year, you add $1,000 of rent to all those units. Not each unit, just total. So you could paint the kitchens, redo the bathrooms, whatever it is. Every $500 That's 5%. So every $500, it goes up by 100,000. Now that's back of the napkin math, but it's pretty damn close. If you can take the rents up by 1,000, 1,500, whatever it is, that's 100, 200, 300. All of a sudden you have all this equity. All you've done is margined on that rental property, raised the rents. So it's basically like owning Tesla, and all of a sudden Tesla makes more money. What happens when Tesla makes more money? The stock goes up. The company becomes more valuable. And then you can borrow from that, right? To put it in layman's terms, how is Musk buying Twitter? He's buying it from margin from Tesla stock. Guy's smart, right? He's not going to pay tax on it. He's going to pull all the equity out of Tesla and buy Twitter. This is what you can do with investment properties. You can be a little Elon. You buy that investment property, you add a little bit of equity in rent. That equity is margined, so it explodes. And that 500,000 becomes 200 grand. Then you borrow from yourself that $150,000. And you know what you do? You buy another property, and you buy another property, and you buy another property, and you're all buying it from the first 50 grand that you bought. Obviously, you have to make right decisions. You want to buy properties that you can put some sweat equity into, and that are in up and coming areas. That's what really, really helps. That's what I did in 1999. I bought a little 2-bedroom in Bucktown, and the rest is history from the equity from that place. But that's what you want to do. And that is the most important reason why you need a real estate professional that has investment background, like myself or other people that can help you on that journey. So we're going to wrap it up. I enjoy this. I've done a ton of little snippet TikToks and Instagrams on everything we talked about today. And I thought it'd be great to do a pod on all of it and what I'm thinking, where I came from in terms of being an investor and trading the Eurodollar product, the interest rate product, and why I come up with these things that I say on social media and having it come together and really working out the way that I thought that it would and where I see things going. So I really see things going in a positive direction. Rates are going to continue to drop. They'll level off between 3.75 and 4%, and you're going to see 4 to 8% appreciation next year. Rents are going to continue to go up, and you're going to see a bunch of multiple offers. And I don't know what people are talking about inventories. I got hard numbers here. In the city of Chicago, inventories are not coming in, which will drive prices up from supply and demand. That's it. Have a great next couple weeks. We'll drop the pod and we'll get back to it. I've got a great guest. I'm going to be meeting with the mortgage broker in about 3 weeks, and we're going to go over kind of what we talked about here and kind of things that he sees that are going to be happening. And we're going to talk about mistakes you should not make before you get a loan. All right, signing off on episode 12, The Jason Theory.